Welcome to Better Vantage by Vanguard, a podcast series co-hosted by Custom Content from WSJ and Vanguard. In this podcast series, we will be talking about issues that are top of mind for financial advisors and investors today. In each episode, we'll be sharing market analysis, data, and insights, as well as strategies to help you invest with greater conviction. And with me today is our co-host, Joe Davis,
Yes.
Vanguard's global chief economist, and
Yes.
resident expert.
I don't know about that, but thrilled to be here, Christine. Thrilled to be here,
It's
Christine.
great to be back with you.
Yeah.
And of course, for this episode, we have our special guest who is Vanguard's head of behavioral economics research, Andy Reid.
Thanks so much.
Andy,
Happy to be here.
welcome. And Joe, today, this episode is going to be really revealing, as only the study of human behavior can be.
Well, again, it's high bar, Andy, but I think I'm really excited about today. I mean, I get to work with Andy. I think it's, think a little bit like Halloween, a lot of tricks and treats here, because there's a lot of things that Andy has brought to my attention for me as an investor, grounded in science. And what I think the listeners are going to get are actionable things that either you can do or perhaps you have it mastered, but friends and family can do to either, minimize losses at the margin or actually make more money.
No pressure, Andy.
None taken.
But Andy, Vanguard's 50 million investors really give you incredible visibility and data into what investors are doing at any given moment. But you're all about the why, right? And the how. Can you talk a little bit about that?
Yeah, it's a great question. So, when we observe behaviors, whether it's, good, bad, or ugly, whether it's intentional behavior or, errors of omission, let's say, the question is always, well, why did they make the choice they did? And I think that's the fundamental question at the heart of behavioral economics is why do people act the way they do? And in particular, why do they deviate from what the likes of Joe and other economists
Because I was
would
supposed
predict?
to be rational.
No, not necessarily what
Yeah.
economists would do, but what economists believe people do. And it turns out that when behavioral economists started looking at actual behavior by actual people in the actual world, they don't follow the models. Our job is to really sort of identify the gaps between what the likes of economists say is the normative thing to do, whether it's, how you should invest, how you should save, where you should hold cash, et cetera, and what people actually do with their real money in the real world.
What actual value has this field added for investors?
I'll kind of call out one of the greatest applications of behavioral economics to drive better choices. And this was the Save More Tomorrow program. And the idea was, they observed all these, let's say missed opportunities for 401k participants to save and invest for retirement. And what they realized is a lot of it boils down to inertia or, let's call it economic impatience. So people would rather have more money now and forego more money later. So they're kind of more likely to spend now as opposed to save for the future. And so what they did is rather than try to fix the person, the key insight was, let's fix the environment. Mm-hmm. Let's fix the decision architecture so that the right choice is the easy choice. And in fact, it's the default or automatic choice. Mm-hmm. So rather than trying to educate people and convince them and persuade them, which is really quite challenging, they automated enrollment in the 401k plan. They automated investment through a target date fund, and they automated increases in the savings rate over time. And they basically estimate this is probably $1 trillion worth of additional retirement.
With a T.
Trillion with a T, in fact. So it's probably the single greatest application of behavioral economics, and it's one that Vanguard was at the heart of from the early days. So.
Do you see behavior of investors, if in your judgment, acting too fast, or do you see the opposite?
I think in this case, we see risks at opposite ends of the spectrum. So going too fast, if you're making impulsive, knee-jerk reactions to, for example, market volatility or the latest news headlines, there's a risk that you won't take into account the full picture, that you might focus on the near term and kind of alleviating maybe some stress, some anxiety in the here and now, and causing the high potential for regret down the road. The other end of the spectrum that we see, it's less about thinking too slow. It's about not thinking or not engaging at all.
I feel like there are more people probably on the do nothing spectrum.
There's a lot, absolutely. What we find in particular, we find cash sitting in retirement accounts where you wouldn't expect it, and where economists should say it does not belong. Imagine a 25-year-old who had their first job. They worked there for, let's say, 3 years straight out of college, and they do a rollover. And they roll the 401k assets into an IRA. It turns out that many of them, if not most of them, leave it in cash for extended periods of time. In our research, we found that often up to 7 years or more. So talk about going too
Imagine that.
slow.
Yeah.
And meanwhile, the market's, hitting all-time highs.
That could be hundreds of $1,000s over a lifetime of someone.
Absolutely. Yeah. So it's sort of the opportunity cost. It's, as you said before, missed gains, essentially. So that's one end of the spectrum.
But let's talk about these biases. Let's go into them
Mm-hmm.
more in depth, because you do a lot of research on blind spots, and
Yeah.
we want to make sure we want to talk about them and see if our listeners, our viewers can recognize any of these in themselves or in somebody that they know.
It's tricky. To be fair, I'm an expert in what people do wrong, not what they should do
Mhm.
right. So I think, I'm not in a position to give financial advice in that way. But certainly, you mentioned blind spots. The dilemma is this. It's a black box. We make the choice, and then you ask people, why'd you do that? And they go, I don't know. One implication of this is that many of these biases that we demonstrate, we're not even aware of them, right? So loss aversion, the average person doesn't realize that they react more strongly to losses than to gains, but they do.
What are some of the things I'm not taking advantage of if I have those tendencies?
So this is the funny thing. Tax loss harvesting is this fascinating optimization strategy that economists would say absolutely it's a no-brainer, but it goes against human nature because you're trying to convince someone to lock in a loss when their motivation is to avoid losses, and they're more motivated in many cases to avoid losses than they are to seek gains. So it's really paradoxical, right? You're saying you'll come out ahead if you lock in a loss.
So how do you bridge that? How do you incentivize, or how you design a strategy around that?
Asking people to tax loss harvest on their own devices, it's probably unlikely. But if you make it a really easy option, and Vanguard actually in the past couple of years has done that, where they when people are placing a sell order, we give them the option that's literally called min tax, and it says minimize your tax burden, which is kind of
Versus first in, first out.
Exactly. Yeah, first in, first out is kind of the classical default, and a lot of people go with it because of inertia. But that's essentially the equivalent of max tax in many cases.
I love where we're going with this. Why don't we talk about recency bias?
Mhm.
And the same thing. It's what is it? I think there's FOMO, performance chasing, rear view mirror investing are all rolled into that. Can you talk about that?
24-hour news cycle, right? It has to do with the half-life of memory, fundamentally. So the idea is when you get people to think about the future or make decisions that implicitly integrate some prediction about the future, I'm going to increase my equity exposure because I think the stock market's going to go up. What weighs most heavily on those judgments and decisions is the thing that's most accessible, the thing that's top of mind. The more recent it is, all else equal, the more available it is to your memory, and the more weight it carries in your judgments and decisions. Every 2 months, and Joe's familiar with this research, we ask about 2,000 investors to predict the future of the market, the GDP growth. We ask them to play Joe Davis, essentially.
They actually do pretty well.
We've done this for 7 or 8 years now, every 2 months. So consistently, we have this longitudinal data set, and we can look at their expectations. 12 months was the sweet spot. Trailing 12-month returns were the best predictor of forward 12-month returns in the mind of the investor. Despite all of our warnings, past performance is no guarantee.
Very low
It's not
correlation,
indicative.
sometimes negative in some markets. You see anything on the trading front too, right? Is there activity that's too much activity? What I mean by that is I'm selling an active ETF and I'm buying discretionarily a new ETF or mutual fund.
One of my favorite paper titles of all time is Trading is Hazardous to Your Wealth. And basically what they showed is that the people who trade more actively have worse performance, worse returns. So they're undermining their long-term goals. Now, you might argue, well, maybe they're garnering some, emotional utility. Maybe it's just fun. But there's a difference between a little bit of trading with a little bit of your portfolio and then making risky bets with your nest egg on a regular basis. The good news is, at least when we look at Vanguard data, and going back to your point about we've got 50 million investors, a lot of data to look at, we don't see much evidence of overtrading, right? If anything, the risk that we see is people that aren't rebalancing, that aren't taking advantage of opportunities, that are sticking with cash for too long in a long-term retirement account.
How can the industry best encourage or incentivize, again, these investors, whether you're an overactive trader or you're somebody that does nothing with your portfolio, to prepare them for the next 10 years?
The good news is a lot of investors are sort of building these portfolios that are kind of all-weather, right? So ups and downs in the market, no problem. And in the 401k space, I think that the adoption of TDFs has been just a game
Target
changer.
date funds. Yeah.
Yeah. Prior to target date fund defaults, you looked at the equity allocation for younger versus middle-aged versus older investors all over the map. A lot of people had all cash. A lot of people were 100% company stock. So they had these either way too risky or way too conservative portfolios. And in some cases, people were, reacting to the market, but in many cases, they were just oblivious to what was going on. With target date funds, you have portfolios that adjust. So if the market goes down, there's an automatic rebalancing. The market goes up, it automatically rebalances. And so it kind of adapts over time to these changing market conditions. So too with advice, I think, for people that, a lot of people don't enjoy investing. I think, the folks in this industry are kind of the exception to the rule. But for many people, investing is something that you kind of have to do, but it's not necessarily something that you derive joy from, let alone something that you're an expert in. Let's be clear, like being an expert in investing is rare. It's the exception to the rule. The average American, sort of lacks foundational knowledge. So on that side of the spectrum, you've got people who are sort of, let's say, unskilled and unaware. So they're overconfident. They think they know everything, make really risky bets, they make more trades, and they get, worse performance. But then there's the folks who are unskilled and aware, right? And they realize, like, I don't know what I'm doing. Unfortunately, a lot of the sort of dominant response in many cases is disengagement. That's incredibly risky. And I think that's where you get a lot of people who just say, investing is not for me.
And will you see a lot of cash drag there? Or under risk?
Yeah,
right?
we see they have lower levels of equity in their portfolio, and it's statistically meaningful. It's like 8%, give or take. I'd have to double check the research, but
sure.
It's
but over time that can compound
hugely,
right?
Well, and it's the difference where, like, if you were 8% off track from your target glide path, you would rebalance. So it suggests, maybe there's an opportunity there.
I hate to ask you for your favorite, but which of these behaviors have you seen impact investment outcomes the most?
I have to say inertia and status quo bias. I think it's just, again, most people do nothing almost all the time. And, and it doesn't matter. It doesn't matter whether it's your 401k, your IRA, your HSA, brokerage account, you name it. And the question is, like, what's happening while you're doing something else? And by the way, it's often not willful inertia. It's just you're dealing with life. Mm-hmm. You're doing a podcast, right? There's things that get in the way.
Never got around to it. Changed my job.
Procrastination.
No, exactly. We were talking with Fiona a few episodes ago. The job changed every 3 or 4 years.
Yeah. Exactly. And I think it's these moments that matter, the life transitions, the events, new job, new baby, you retire, windfall gain. There's a lot of these events that happen. I think it's on the choice architect. So it's on the vanguards of the world to create menus that make it easy, that make it simple, that make it fast, that make it effortless. And it sort of, satisfies your desire to take the happy path. As you may recall, when Fiona Gregg was here in the episode on retirement, she talked about when people switch jobs, their savings rate declines. Yeah. They get a raise, but they save less. Yeah. Why is this? It's because they get sort of anchored on this new, default or new savings rate, and they don't port over the old one. So a simple way to change the anchor, you just ask people, what were you saving in your last job? And people could tell you a lot of times. They're like, oh, I was saving, 10, 12, 13%. Say, all right, let's pre-fill that and go from there.
So what I'm hearing from you is that, listen, there's some of the too fast behavior and the too slow. I got to be honest, I would have thought the too fast was the dominant of the population, but I'm hearing you say, no, there's actually the too slow, and there's things around cash drag and the faults that, I don't know, I almost took for granted. Maybe it sounds like I had a bias that's actually the greater opportunity for potentially if our listeners are a swath of the random population. So that's something that sounds like a checklist to do. Yeah. And then the second one was related to that, just in terms of the inertia and then the expertise.
Oftentimes with your portfolio, it's not like you have 5 minutes to make a life or death decision. That's incredibly rare. But there are these moments that matter that come up where, like, you really should make a choice and you should think about it and you should make the right choice, because if you go down the wrong path, over time, you're going to be in a much worse position.
Is there a design for that prompts you that you better look at it now for the next 5 days?
Yeah, give me some of the moments that matter.
I mean, a lot of times, and this is something that Vanguard is increasingly developing, sort of tools, technology, using AI, among other things, to really personalize. How do you nudge people when you know something's going on? Hey, they're sitting on a bunch of idle cash in their retirement account. And we've been nudging them, and we've been sending them personalized messages, and we've actually been able to get billions of dollars out of idle cash and into the market working for people.
As we wrap up today's episode, you've shared a lot of insights, and hopefully people recognize themselves, recognize that there is a solution. What would be the key takeaways?
Check your blind spots. Just, again, like in driving, if you change lanes without checking your blind spot, you're going to have a bad time. So I think just like looking at your account and making sure, is this what you intended it to be? Because again, you forgot, or maybe the market drifted. And that 60-40 portfolio that you set up so carefully and deliberately 10 years ago is now, 80-20? And you didn't want it to be 80-20, but you didn't realize how drift works. So I think it's a little bit like, if you haven't looked in your fridge in a few weeks, you might want to take a look, right? Maybe do a little bit of spring cleaning. That's a bad analogy.
I don't know. That's going to stick with me.
Yeah,
though.
I know,
So
exactly.
the fridge,
It's like,
if you haven't opened it in 3 or 4 weeks or
Maybe it's the back of the
3-4 months.
freezer, but it's
No, but that's it. So it's not logging on every day, but let's not leave good hard-earned dollars not working for us.
Thank you so much, Andy, for all the terrific insights that you shared with us today.
Thanks so much.
If you enjoyed this episode and found it helpful, subscribe and share.